Hi, everyone. Thanks for tuning in to another episode of Our 2 Cents on Your Dollar. I'm James Enriquez.
I'm James Credo.
I'm Alexis Villarreal.
And we are here with Dr. Maroula Khraiche, Associate Professor of Economics at UTRGV. Welcome.
Thanks for having me.
So, how long have you been at UTRGV?
This will be my 9th year almost. Yep, 9 years.
And what classes do you teach?
I teach mostly macro classes, principles of macro theory. I also teach international trade, economics of government. So those are the range of courses.
Ooh.
Perfect.
Yes. Salivating. Okay, where should we start? International trade. What is, well, you know what, let's back up.
I was going to say, I haven't been in school in a while. I was like, what's macroeconomics?
Yeah, right. So you mentioned macro. What's the difference between macroeconomics and microeconomics?
So macroeconomics is kind of like a zoomed out view of the economy. When you think of microeconomics, you think of industries, firm behavior, consumer behavior, pricing decisions. When you think of macroeconomics, it's mostly international finance, credit markets, interest rate determinations. So basically kind of a zoomed out view of markets. And we typically focus on what we call general equilibrium analysis. So we want to see how markets interact together to spit out those aggregate prices.
Okay. You mentioned interest rates in there.
Sure, yes.
I'm sorry. I just want to get to so much. Okay, interest rates. How are they set? Who sets them?
Well, it depends on which interest rate you're talking about, right? But if you're asking who's setting them, you're probably talking about the federal funds rate that is typically targeted by the Federal Reserve. So those is the interest rates that banks basically charge each other in short-term interest rates for loans. And so the Fed typically targets those. So in the past year, before they just had the recent cuts, they've been raising these interest rates or making an effort to raise them. And so we think, or they think, so if it's expensive for the banks to borrow, then they're not going to lend as much. And so that's going to put kind of downward pressure on demand, downward pressure on prices. So they raise the interest rates when they're trying to cut prices, as they have been doing the past 2 years or so.
Yeah. So I've always found that interesting, that we cut interest rates to cool the economy.
It's the opposite.
Right.
Yes.
Well,
we cut the interest rate to stimulate the economy.
I meant to say to cut inflation, right?
Sure, yes.
Inflation is inflation is an indicator that maybe might lead to recession or that the economy is hot. So we want to, right?
Likely,
so,
yeah.
You know, can you put some context around that?
Sure. So a best way to think about it is, I don't know if you guys remember your econ courses. Just think
We do not.
I don't want to.
Yeah, sorry to bring back trauma, but basically you want to think of just any supply and demand, right? When demand is too high, there's pressure on the prices to go up. So if you want prices to go down, you want to kind of curb demand. One way to curb not just the demand for a particular good, the demand for all goods, is to basically tighten credit and reduce liquidity, reduce loans. And you do that by basically reducing money supply and raising the interest rate.
Dr. Khraiche, why not just let the markets, because our clients would comment,
Sure.
Free markets.
Sure.
Why not just let the markets figure it out? If it gets too expensive, wouldn't we stop spending? If it's cheap, we'll buy more.
So that's a good point. And there are economists who think like that, right? So Milton Friedman's, I don't want to say shtick, but famous theories point to this direction that the central bank should just kind of keep nice, steady growth rate of money supply and let the pieces fall where they may. However, history has shown that monetary policy has great potential to stimulate the economy during recession, and it has great potential to stabilize prices. So in fact, it's a wasted opportunity to just sit there and say, let the chips fall where they may. In fact, research has shown that monetary policy, good monetary policy, can stabilize prices and get us out of recession when we need to do that.
Yeah, earlier you mentioned that the Fed sets fund rates.
Sure.
The Fed funds rate.
Tongue twister.
What sets the other rates, like mortgage rates, for example?
So you can think of the federal funds rate as kind of like the benchmark. If I am a bank, the federal funds rate is what I pay for loans. So if I'm going to think about what am I going to charge other people for loans, a benchmark is going to be what I'm paying. So if I'm paying a lot for loans because the federal funds rate is high, then I'm going to set a higher mortgage rate. I'm going to set higher rates on car loans and higher rates on credit cards. So the idea that if you make it expensive for the banks to borrow from each other, they're going to make it more expensive for consumers and firms to borrow. And that means that there's going to be less investment, less spending, less aggregate demand, and lower prices.
Is that the same thing, Doc, as controlling how much banks should have in reserves?
It's exactly that.
Okay,
yes,
okay,
right?
I see.
So this is exactly the flip side of it, right? So if it's expensive for me to borrow, I'm going to sit on more reserves rather than lend them out.
And how's all this stuff affecting corporations and businesses, right? If there's all this contracting, coming in, coming out with funds, how's that going to affect businesses overall?
So if the Fed wants to accomplish this control of prices, which they have, because they've recently cut the rates, which means that they have done a good job in controlling inflation over the past 2 years. We want the businesses to invest less. We want them to spend less. And so it would affect them by actually reducing their economic activity. Now, what happened in the past 2 years is that we didn't see such a huge decline in investment is because investment overall is higher. So we didn't see this aggregate decline in investment, but ideally, or the goal of the Fed is to reduce those investment activities, reduce spending activities, again, to kind of remove the heat from the prices.
Yeah. Can we talk about tightening credit?
Sure.
Talking about the Federal Reserve. Can we talk about the mechanics of what that looks like letting things roll off their balance sheet, the Fed, that is? Like, what does all that mean whenever we hear that on TV?
Okay, so I think maybe you're talking about quantitative easing.
Yes.
So the idea here is that technically or usually the Fed will target short-term interest rates, right? And that would be the federal funds rate. But another interest rate that they can target if they wanted to kind of curb prices even more is long-run interest rates. So to target long-run interest rates, they will buy and sell long-term assets, kind of like, say, those securities that you're talking about. And so they have been doing, so this is what they call quantitative easing. And so they have been doing it for a long time. Last I read is that they've reduced that quite a bit. But so these are just all different tools to accomplish the same goal. So sometimes in the short run or, for example, monetary policy could be less effective. So you need to come up with new tools to affect interest rates in the long run. And quantitative easing is one of those.
Okay. So we mentioned that the Fed just cut rates again.
Sure, yes.
Markets went down dramatically on
Sure.
the news of that because of some comments the Fed chair made. Can we talk about the difference between markets and economy?
Sure. And so my understanding is that the markets were spooked because they were expecting that the forward guidance by the Fed implied that they were going to keep cutting. But Jerome Powell said, we're going to cut, but not as much as you thought. And so the interpretation of what he said is that there's fears of inflation for next year. And so that's what kind of spooked the markets a little bit. But from an economist's perspective, markets spook way too easy. So Samuelson is a very famous economist, and he has this famous quote is that stock markets predict recessions 9 out of 5 times, right?
It's like our favorite word, right?
Right. So the fluctuations, the daily or even weekly or even monthly fluctuations of the stock market doesn't really make too much difference for the economy at large. But to go back to your question, what is the difference between the stock market and the economy? The stock market's just one market within the larger economy. And so from a macro perspective, what does the stock market do? It allocates capital, right? So if you have some funds you want to save and make a return on, and somebody else has some great idea or a productive use for these funds, the stock markets are able to match these two, and then they can share returns, they can share risk. And typically that will increase investment, and in the long run, investment is one of the main drivers of economic growth. So that's the major part of the stock market. And not just the stock market, any capital market that facilitates this borrowing and investment meetup. Now, that's not to say that the stock market is not important to the real economy. In fact, we saw, for example, in 2007, 2009, when it was most of the shocks were in the financial sector, that the real economy actually suffered. So even though it's only one part, it's quite an important part for the real economy because it basically greases all the wheels and all of the production that is taking place in real terms.
Does the Fed look at the stock market to make its decisions on what to do with monetary policy?
So that's fantastic, and it's actually slightly controversial. So
That's what we do here.
That's what he does here.
That's a lot of questions.
So the basic idea is that sometimes the fluctuations in the stock market are reflecting what's happening in the real economy, right? Because, I mean, at the end of the day, what is the price of a stock? It's reflecting future earnings, reflecting future investment prospects. So if that's slowing down, it's implying that something is happening in the real economy. And typically, because it's so fluid and volatile, sometimes it will show you a signal faster than actual GDP. So it'll dip faster than actual GDP. So the Fed does in fact watch the stock market to kind of extract information about the real economy. Now, whether they should act every time the stock market is declining or overheating, that becomes controversial because it goes back to what you were saying about this is just a market, it's a liquid market, it's a volatile market, so maybe sometimes it needs to go through these changes and it'll revert back to the mean when it's done with all the noise.
2 questions real quick.
Sure.
1, what is GDP for our audience? And 2, who controls the Fed?
Oh, okay.
Wow.
We're going there already.
I was going to go there since you had already. So, good thought. Good thought.
So GDP is gross domestic product. So the easiest way to think about it is that what is the economy producing in any particular year within the borders of the country? So even if it's a foreign firm, as long as it's operating within the borders of the country, its production is counting towards gross domestic product, counting towards GDP. So basically, it's a measure of economic activity. What we're producing, if we're producing a lot of it, then economic activity is going up, and then we expect income to go up because gross domestic product at the end of the day is going to be also income. And if it's slowing down, meaning income is going down and production is going down. Now, who controls the Fed? So the Fed is set up in a really neat way to make it a little bit independent so that it's not too influenced by, say, Congress or any particular president, because the independence of what we call the monetary authority, the independence of the people who control printing the money is very important from those who spend the money. So the 2 entities, the fiscal and the monetary authority, need to be separate in order to kind of not have people print money so that the other people can spend it.
How
right?
often do people think that they're together? How often do you have students? How often do you have people that you have conversations with that think that they're actually
The same thing, right? So I think probably a confusion is in some countries, developing economies, the independence does not exist, or there's a lot of problems in the way the institutions are set up. But even till the last day of class, I'm always explaining to my students the difference between what we call fiscal policy, which is Congress, the president, and monetary policy, which is the Fed. And, you know, it's not that they're completely independent. Of course, they influence each other, but the institutions are set up in a way that they should not influence each other. But of course, they're still run by humans, and there is stories from, say, the 60s where the Federal Reserve chairmen were influenced by presidents like Nixon and Lyndon Johnson. So there is those stories that historians tell, and actually those are periods of really high inflation. So it just tells you that to control inflation or to have a stable economic system, it's very important for the Fed to be independent from the fiscal authority.
who hires the chair?
So they're appointed, right? The chair is appointed. However, the decisions are usually made by the board of governance. So those are also elected to these positions or hired in these positions, but they have such a long term that it exceeds the term of any particular president, so that they're not influenced in such a way. Yeah.
You mentioned recessions earlier. What is a recession?
Oh, so that's also a really good question. So recessions are periods of declined economic activity. So the economic activity has to slow down, so GDP growth rate has to decline, and it has to be pervasive, or it has to diffuse across sectors of the economy. So for example, just one sector declining is not enough to say a recession. So several sectors, or it has to be diffused across the economy, the slowdown in economic activity. There should be a sustained slowdown in economic activity, and typically the duration, right? So a great example is the COVID recession. So that duration was very short, a quarter maybe, but it was pervasive, and the drop was significant. And typically, the NBER, the National Bureau of Economic Research, is the one that says, okay, we just been through a recession, and it's usually what they call retroactive. So as soon as it's over, then you're like, oh, this was a recession. And the reason is because you're looking for the peak, right? So if this is the peak, this is the highest point, and then we've gone down, to make sure it's a recession, we don't want to see another peak. So you have to wait. So you're far enough from the last peak to know that you've actually gone into a recession. So it's, and this is why people look at the stock market and look for what they call the leading economic indicators to see, okay, well, are we in one? Have we gone through one? And so on.
Do y'all have a crystal ball too?
Sorry?
Do y'all have a crystal ball also?
Some economists do, but we don't share it with the financial planners. Sorry.
Yeah, you know what? I actually wanted to point that out for anybody that's watching that has investments or has an advisor. So you're telling me that MBRE decides after the fact of a recession, and we don't even know it's a recession until after the fact.
Yes.
Y'all get where I'm going with this? We don't know when it's going to happen.
Yes, I mean, it's quite hard to predict recessions, right? So this is what I tell my students, is because the first thing when you tell people you're an economist, you're like, oh, you guys are useless, you can't predict recessions.
Wow.
And
Wow, I never heard that one.
so if you think about it, to predict anything using past data, there has to be some regularities in the data that you can replicate, right? Some cycles. Now, if you look at past recession, it's not like every 5 years we have a recession. And it's not like if we have a recession, it's definitely going to be to 3 to 4 quarters. It could be 1 year, it could be 1 quarter. So the fact that they're not regular and the duration is not regular make them very hard to predict. However, once you are in a recession, you actually can tell what's going to happen in the next 2 to 3 quarters. So we can predict using small windows of time because the data is quite choppy, right? It's persistent. But we can't predict, say, a year from now and so on. So it is quite difficult to do.
Are economists willing to put a country into recession to avoid excessive inflation? Which one would they pick?
That's fantastic, right? So that's kind of a very important question. And so from the Fed perspective, the Fed has two kind of what they call mandates. So they have low unemployment and also stable prices, and the two can be in contrast, right? So what I usually tell my students when they ask me this question is that, well, it depends. If we are in a health crisis, people might die, then, well, we put unemployment first and we make monetary policy expansionary. But if we're in a place where prices are quite high, they're destabilizing the economy, they're imposing costs that are too high to put up with, then we prioritize prices. So it has to be kind of a decision based on what is going on, based on several factors. And so at the end of the day, there is a little bit of judgment that takes place.
So are recessions necessarily a bad thing? Like it's a normal part of the economy, right? Or an economic cycle.
Exactly.
I mean, nobody ever wants to go through that. You don't want unemployment to go high. You don't want to be without a job. You don't want your assets to go down in value, but it's kind of a normal part of the, right? Yeah. Okay.
So the field in economics that studies recession is called business cycles. So we understand that the economy goes through cycles. So there is actually some economists who think, since we go through cycles, just let it be. Don't intervene using fiscal policy. Don't intervene using monetary policy. One day the economy will bounce back. And that's where Keynes's famous line says that in the long run, we're all dead. So when will it bounce back, right? If it's bouncing back in 10 years, then maybe that's too long for us to wait. It's not good to have the economy be with so much unemployment for so long, producing below capacity for so long. So I guess my answer would be, is that it depends on when do we think it's going to come out. So maybe if we think it's a small recession, maybe, cut a little bit of rates and wait. Maybe it's a long, painful recession, then maybe it's time for something more powerful.
You mentioned leading and lagging indicators earlier.
Sure.
Which one's leading? Which one's lagging? Market or economy?
So there's many leading. So the leading would be probably the stock market is a leading indicator. So usually it will dip before a recession happens. Another very important leading indicator is actually construction permits. We do see that the housing market slows down before the economy as a whole does. Consumer confidence, manufacturing hours. So there is a bunch of indicators that we see that dip before GDP actually dips. So we want to watch for those. But even if you, and so the conference board, they come and they average all these indicators together and they create the leading economic indicator. And so sometimes you'll see that it has dipped before the recession, and sometimes you'll see that it dipped with it. So it's not a perfect predictor. I mean, just look at the COVID recession. There is no indicator out there that would have told you there's going to be a dip March 2020. No way. So.
Yeah. Or that the market was going to be up at the end of the year.
At the end of the year. Yes.
Anyway, okay, so let's get into your specialty, international trade.
I'm getting very excited. It's a kid in a candy store.
Well, okay, let's start here. What are free trade agreements?
Okay, so we have a semi free trade agreement with the North American Free Trade Agreement, which was relabeled as the USMCA. And it's the idea that goods and capital can flow, mostly goods because it's a free trade agreement, can flow with very little barriers in terms of quota and in terms of tariffs, taxes on international goods. And people usually do that because it's beneficial for the economy, right? So it's usually when we look at how countries grew, rarely do you see a country that grew after being closed up. So having free trade tends to be a prerequisite for economic growth. It's not sufficient. So just because you have free trade doesn't mean you're going to be a rich economy. But it seems to be very difficult to grow and be, say, a rich economy without having free trade first.
So you said another magic word. What are tariffs?
Okay, so tariffs, they used to be kind of an obscure word, but in the past few years, everybody knows what tariffs are. They're basically just taxes on imported goods. So if you buy something foreign, you're paying an additional tax on it. It's usually charged to the firms that import it or charged to those who are exporting it. So obviously, what does a tax do? It reduces quantity bought and sold and increases the price of the good bought and sold. And so this is what a tariff is.
Yeah. Are those, do they lead to inflation?
So this is a really great question. So of course, if you're in a state where there's already inflationary pressures, the idea of tariffs would also probably push up prices and would increase those inflationary pressures. For sure, so it also depends on what eventually gets taxed and how people adjust and substitute across goods and services, how fast these tariffs come into place, how much of these tariffs are passed through the consumer and how much are absorbed by the producer. So of course there makes sense that they're going to raise prices. So some of the tariffs that are proposed by the Trump administration, the estimates go anywhere from 0.4% to 0.6% rise in consumer prices. So it's a substantial amount if you are already trying to kind of control prices.
You hear a lot of commentary about tariffs possibly being regressive, like a regressive tax.
Sure.
Can you provide some commentary around that? Like, what are regressive tax, and is that even true that they are regressive?
So that's a really good point. So the idea is that if the tariffs are on, say, lead to rise in final goods prices, typically, if you're a lower income household, you spend a bigger chunk of your income and you save a lower chunk. If you're in a rich household or a higher income household, you save more than you spend just in percentages. Of course, the dollar amounts, those who are higher income will spend more. So if you are spending a bigger percentage on final consumption goods and those final consumption goods are more expensive, it means that you are paying more for the tax. Or getting affected more by this tax than people on higher income. So this is why people say that it's regressive, right?
Yeah.
But to be honest, that's kind of one of the less problems or less issues with tariffs, right? From an economist perspective, if you ask any economist, we tend to say that free trade is most efficient, right? So everybody does specialize in what they're good at, and then which means you can produce more of that good, and then you can trade, and even without any innovation, you can achieve economic growth just through this trading.
So why use the tariffs then, right? Why are the tariffs on the table right now as far as being a tool to be able to conduct business with these other countries?
That's a really fantastic question. So this is a field in economics called political economy. So political economy tries to understand why is it that optimal policy, optimal, most efficient economic policy is not the one being adopted or not the one being passed. And the reason is probably because it's not politically feasible. So we try to understand why it's not politically feasible and why does the economy end up with the second best. So that's basically the answer, right?
Is the second best always the one who's the strongest?
So it depends on the political system. So it depends who benefits, right? So typically, international trade benefits consumers. So if you take all the benefits and you spread them over all the consumer, each individual person is not benefiting that much. But overall, on net, it's a benefit. But the losses seem to concentrate it on smaller groups. So if the smaller group is able to organize, then they're able to get the political establishment along their lines. They can, say, lobby more, pay more money, and do whatever to get the political system, because they're gonna, the losses are concentrated over a smaller group. Now, on net, of course, tariffs are gonna create a net loss, and you would think that would not pass, but because the imposition of the tariff creates a net gain for a smaller group that is concentrated, they tend to kind of have their voices heard. So the famous example is always the sugar restriction, right? So there's a lot of restriction on how much sugar is imported. So that keeps the prices high. Now, that costs the consumers about, say, $3 billion, for example. But if you look at per person, it's like maybe 30, 40 bucks. You're not going to go hold a sign and protest that, right? But how much are the sugar producers gaining? They're not gaining as much to offset the loss by the consumers. But each person or each producer maybe, say, 100,000. So they're more likely to go lobby and protest to keep those in check because the losses are more concentrated on them. So the answer to your question, why are on the table even though they are inefficient, it's because there are special groups or smaller groups in the economy that are louder and better organized.
Don't believe that for a second. Not here.
No, never. Money doesn't have any influence.
No, none whatsoever. Okay, so is it better? What's better for an overall economy? Is it for producers to eat that tariff or for the consumer to eat that tariff?
So from an economic perspective, when we calculate total welfare, we include both producers and consumers, right? So it's total welfare has to include both sides of the market. But I guess your question is where the distribution is going to be, who's going to take the bigger hit, right? And so who takes the bigger hit depends on the availability of substitutes, right? So if the consumers are able to substitute towards a cheaper thing or a domestic product, then it is the producer who's going to take the hit. But if the consumer is unable to substitute and has to buy that good, then the consumer will take the bigger hit. So on net, it's typically the consumers who lose more because especially the way the Trump administration is suggesting, they're not going to implement the tariff on one or two goods. They're going to implement it on wide groups of products. So you can't really substitute a way between one or the other. So probably in this case, the consumers would be the one who would take the bigger hit.
But some reason why that's being proposed is because they want to bring back manufacturing, right? Is that what it is?
So that's kind of also, there's a lot of outdated economic thoughts that is going into these particular tariffs. So bringing back manufacturing is not really, should be an economic goal anymore, right? So there is some geopolitical considerations. For example, what the Biden administration did by trying to bring the semiconductor industry here to make sure that most parts of EVs are manufactured here. So that's basically to take power away from, say, Chinese production. So some of it is just kind of a play for geopolitical power, not necessarily for economic gain. So
I guess how important is it, though, that we actually have some of those things going on in the United States or on this side of the world?
So again, if we want to think, okay, what is optimal policy? Optimal policy is to have peace and to have it spread all over the world, right? But also now a more realistic thing or political economy thing is perhaps maybe it's important, but not just for geopolitical concern. Just think about all the supply chain interruptions that happened during the pandemic. You don't want production to be very far, or you have to cross seas for it. But some of the tariffs are being proposed on Mexico and Canada. So those are typically allies. They're not, political adversaries for the United States. So it's kind of strange that we would impose tariffs in that way.
What does onshoring of manufacturing activity do to prices?
So at the end of the day, what happened after the first Trump administration, so there was a lot of tariffs that were put up, and there was kind of a redistribution or kind of reshuffling where the capital went and where the investment went. And then, the Biden administration came, they also didn't remove a good chunk of these tariffs, they kept them there. The Inflation Reduction Act, like you said, made sure that everything is kind of made either domestically or close by. So again, reshuffling of the capital domestically. Now, a lot of this is being subsidized a little bit by government spending, so maybe prices are not going to go up that much. But at the end of the day, if this is not where you would want it to be, if the firms had to reshuffle to adjust to political situation, then it's not first best. And there must be some inefficiency lost, and the inefficiency is going to show up in a little bit of higher prices.
It seems like efficiency is the way to go, which requires to do nothing, which makes it very difficult. Sometimes I get jealous when I see China. We kind of make fun of them a little bit when they build cities out of nowhere. But then I think they have so much money, they can build a city out of nowhere. They can take the risks. Is that a efficient way to grow business, the economy through the government? Or when you have that so much money, you can take so much risks? Or is it better to just have the free markets take care of it?
Well, as an economist, I'll always say the free markets are better than the government. They do a much better job. And China, actually, they have a problem. So the real estate sector is not doing very well. They have overbuilt. A lot of their firms are inefficient because they rely so much on the government. And actually, this brings me back to another kind of indirect critique of tariffs, is that if you protect these domestic firms through these tariffs, what incentive do they have to be more efficient? So once they enjoy the government protection, then they're going to, instead of use resources to be more efficient or more innovative, they're going to use these resources to rally the government or lobby the government to keep the protection. So whenever the government intervenes in the markets in that way, in an artificial way, firms tend to be inefficient because they don't have the incentive to be efficient, right? The best way for a firm to be efficient is to know it's do or die, right? So
So let's say we were not in debt,
yeah,
and we had money. How should our government spend that money?
Well, this is actually quite tricky because you had to say, what if we weren't in debt, right? So
Yeah. Wait, we're in debt? I didn't know.
No, we can just keep printing money. We're good.
We're good.
We have the printer.
Right. So for the United States, a lot of people say that the number one issue facing the United States in the next few years is the ballooning deficit and the government debt. That being said, a lot of that spending is inefficient, and there's a lot of room to improve. The way they spend on education is inefficient because there's a lot of spending, but the outcomes are quite bad. Health spending, so we have a lot of health spending that happens. The outcomes also are quite bad. So for the United States, there's going to be spending on infrastructure, which, the Biden administration has done some of that in the past where they've tried to spend money in that direction. But instead of actually thinking where should the money go, we should see, okay, how can we spend it more efficiently to get the outcomes that we want?
What do you say to people that say you don't have to pay it off? What's the big deal? You can just grow your way out of it. Like, why do you have to pay it off? Like, what's the worst thing that could happen?
Well, that's fantastic. The government doesn't have to pay it off. So that's the great thing about government debt is you can roll it over forever. Mm-hmm. The only issue with that is that the growth of the debt cannot exceed the growth of GDP. Now, the deficit is now going to be 7%, I think, next year. By 2035, if all the tax cuts come into place, it's expected to be up to 12% of GDP. So that's growing at a much faster rate than income. Sure, we can grow our way out of this debt, but not if it keeps increasing faster than growth.
Is that a concern?
Of course, yes. I would say most people are worried about, or most economists, if you had to say what is the number one challenge, economic challenge for the United States, it's the ballooning deficit and the increase in the debt.
How does that affect your everyday person, though? Your teacher, your professor, your small business owner? How does that affect them?
The number one is going to affect it actually with higher interest rates. So this is the long-term interest rates. So as soon as there's a risk on the government not paying back its debt, then lenders are going to require a higher interest rate on the next debt. So now that you're going to roll over your debt, when you roll it over, now you're rolling it over at a higher rate. So if the government is paying a higher interest rate on its debt, everybody else is also paying a higher interest rate on its debt. Secondly, a chance of the government defaulting becomes also a substantial threat. And that case is hugely destabilizing to the economy if a government defaults on its debt. And thirdly, a good chunk of the deficit now is going to go to paying interest. So now this is almost non-productive use of the collected taxes so now you're rolling over the debt not just to pay for your spending, but to roll it over even more. So that becomes quite a challenge.
So I believe all that, but if I were a skeptical person,
Okay.
which I am not,
He's not. He really isn't.
why have they not been downgraded? They, as in the U.S. Like, why hasn't S&P or Moody's come in and said, hey, you know what, guys, y'all are double B.
There has been periods, right, where they would get dinged on the debt. So I wouldn't say they have not been downgraded at all. So there has been some times.
What are they graded now?
Right, but but to double A, which even at that point was like, oh my goodness, they've lost
That was a
triple
big
A,
deal.
right? It was a big deal. I remember that.
Yes.
Yeah, but it's at the end of the day, it's still double A, right? It's not double B junk bond.
Yes.
So
They're good for it.
I mean, that's kind of what we're saying.
It's guaranteed.
No, seriously, why aren't they being downgraded more? And is it really? Can we do something about it? What is it at right now? Is it 35 trillion?
You would like to downgrade it yourself?
No. I would like to. Can we reduce the 30? Is it 35 trillion?
It's quite substantial. So it depends on whether you're including internal debt, just external debt. So yes.
Oh my goodness, it could be
Whoa.
worse.
Explain that, because I think a lot of people just think there's just one number.
No more explanation. I'm getting scared. Stop.
This is supposed to be an optimistic podcast.
Is that a big number? Is that a big number?
So, but just to go back about the ratings, I don't know. I mean, we were all fairly young in the 2007-2009 crisis.
Yeah.
And a lot of the securities that turned out to be busts were highly rated.
Yeah.
So I don't know how much we need to, wait for the the rating agencies to tell us, oh, you've messed up. I think by the time that happens, I think we're way far gone. So anything needs to be done before that, not after the downgrade happens. Yeah.
If the growth rates for Western countries are slowing down because they're mature economies, and our debts are going up, we've seen periods in the past where we've had our total debt 100% of GDP, but we're able to pay it off. How do we get it to a sustained level, whatever that means, given where we are now?
I mean, the easiest thing is cut spending, raise taxes, and
Who's going to do that?
who's going to do that?
No one wants to do that.
Nobody
way.
will ever do that.
Yeah.
No president.
I love how you
no-
said that with no hesitation, because as an economist, that's awesome.
Well, that's what I tell my students. The solutions exist. They're quite easy.
Right.
But is the political will there to get them
Right.
done? And nobody will ever campaign, or don't worry, I will raise all your taxes and get rid of your debt. Nobody is going to win that election. So it's
Because it's a math problem, and so it hurts everybody. So
right. Yeah.
yeah.
But it's not impossible, right? So just a little bit of you closing some of the loops in the tax system, maybe raising taxes on certain parts. Actually, from an economist perspective, the best tax to implement is the value-added tax, the consumption tax. Because we don't want to tax investment. That typically hurts growth. Investment is really good. So tax consumption. People will save more, and you will collect enough to figure it out. So
I've always wondered, what's the difference between a VAT and a tariff?
VAT could also be for domestically produced goods.
Oh, okay.
Right? So any good, it's a consumption tax. You go, you buy anything, you pay a VAT. They're very popular in Europe. They have the consumption taxes, and but again, so sometimes cultural and the way things have worked in a particular place prevents that from happening. So this is not something Americans are used to. So to introduce a new tax across the board.
I was going to say that would kind of kill people from spending, right? Which is, I think,
Yes.
what the goal is, to try to get people to spend more money, and that would obviously
In
tighten
the
things.
short run.
Correct.
But in the long run, for economic growth, we want people to spend less, save, and invest more.
Would you have that on top of income tax? Have income tax and that?
Yes, that would be
Okay.
separate. Yes. That would be something you pay when you go buy something at the
Yeah,
store.
every time you buy, a carton of eggs or whatever, milk, right? There's going to be some sort of extra little surcharge. And then I'm assuming it's worse for, maybe adult items, right? Cigarettes,
Right?
alcohol.
That would be an excise tax. Yeah. So
James did some research, and I don't know if it's true, because he did the research, not me.
Misinformation.
But
Sorry, I had to-
if it's right, we were shocked to find out that income taxes in the U.S. is a new thing. That before we only had tariffs. Is that true, or did we just make that up?
it's a really long time ago.
Okay.
I did
He
not
did the
say
research.
that.
I'm just saying what he researched.
Yeah, Abraham Lincoln was not recent. I think
I don't want to say the year wrong, but maybe that was like 1800, late 1800s. But
According to Credo, that's like yesterday.
Yeah.
he thinks in hundreds of years. Anyway.
well, I mean, part of the so when the Trump administration talks about all these tariffs, they are using it as also revenue generation that's going to make up for some of the shortfall in the deficit. Unfortunately, they're also talking about some sort of additional tax cuts. So, it comes from here, it goes out that way. So it's.
But it does seem like their main objective is to, cuts, right? It seems like they're attempting to make cuts, which is kind of in line with what you had suggested. That's going to be something that they're going to do to try to help offset this deficit that we have.
Yeah, but I mean, they're talking about some spending cuts, and I'm not, at the end of the day, they're talking about more tax cut than they're talking about spending cuts. So but I mean, typically, Republican, when Congress or House are typically controlled by Republicans, they tend to worry about the deficit more. So even if there's some new proposals to cut taxes, there's the hope that they would not approve these sorts of things until the deficit comes back into normal levels. So 6-7% deficit of GDP is way too high. If there's no war going on, if there's no huge recession, it needs to go back to say 3 or 4%, That would be kind of a good number to go back for.
Is that where it's normally at historically?
Yeah, I say last. I want to look up the exact number. Yeah, but
So
since COVID, it's gone up and it has not come back down.
'Cause I know. Sometimes people kind of always think of recent times and they forget that they used to be different in the past. I know interest rates are also very similar to that, right?
Yes.
Interest rates still are relatively low, right, compared to what they have been in the past.
For example, compared to the 80s, right? When in late 70s and early 80s, when Paul Volcker, that was the last time we had huge inflationary pressures, and the interest rates were much higher in order to curb those. So yes, exactly. It's all in relative terms. Yes, a very good point. Yeah.
Okay, so speaking of cutting spending, my brain only thinks in 6 zeros, can't think in 9 and 12 zeros. Is the deficit's in the trillions, right? Is that what it is?
Sure.
Yeah, okay. And this new government efficiency, going back to the E word, this Department of Government Efficiency, they're supposed to cut
Well,
some...
it hasn't got established yet,
Right,
so
right.
It's in the
I won't
works.
count the eggs before they hatch.
Yeah.
You're excited though.
An establishment. So I think a little bit of a scary part about that is the fact that they're coming in and they're threatening all this decrease in federal employment, right? So it's not like there's been a huge increase in the number of public servants. So, also that's also a lot of jobs lost. So maybe there's better ways to cut things than to eliminate large agencies altogether.
That's kind of what I wondered, because I think they're estimating 500 billion or something like that. I mean, that to me that sounds like a drop in the bucket when the deficit's like 35 trillion or so.
But that's always the case. Whenever they sit down to talk about spending cuts, that's always what they do. They trim around the edges and
Sounds good, feels good.
yeah, right.
Okay.
Yeah.
Dr. Khraiche, we really, really appreciate your insight. That was amazing. Can't wait to see what happens. We're going to look into our crystal ball. We'll let you know if we find anything.
We'll let you know if you were right.
Well, we appreciate you tuning in. That's another episode of Our 2 Cents on Your Dollars.